gross margin of consumer goods such as Guinness Nigeria and other listed firms on the Nigerian Exchange are taking a hit in their latest earnings following the heightened cost of sales, among others. Now, these stem from high inflation, utility cost increases, and currency devaluation. Oluebube Nwosu, Consumer Goods Analyst at Vetiva Capital, joins me now for more on this. Oluebube, thank you for joining us today.
Thank you for having me, and good afternoon.
Well, let's get right to it. Looking at some of the numbers from Boa Foods down to Guinness, Dangote Sugar, the numbers don't look too encouraging. Obviously, we've had a number of conversations, and of course, with us here with other analysts, and we've talked about key metrics, particularly inflation and the devaluation of the naira and how it continues to impact on especially consumer goods companies. But looking at these numbers, what are your thoughts in terms of how they align with what the forecasts of analysts have been in the run-up to seeing these numbers come through?
Yes, rightly said in your introduction, gross margins are currently being pressured, and that's what we're currently seeing across board. And this is what we pretty much expected, given the fact that there's only so much that of higher price or higher cost that these companies can easily pass to consumers without losing a lot of volume. And so we've seen these companies have to manage volume loss with price increases. So if their input costs go up by 100%, they have to determine just by how much they want to increase their final price. And many a times it's not going to be the exact 100%. It will be slightly lower. And when that happens, is when you can see their gross profits not grow as fast as their revenue, and that's because the gross margins have reduced. So we're really seeing that across the board. We're saying double-digit growth and top line, so above 50% for a lot of them. And then for the gross profits, we're seeing the growth being lower than 50% for a number of them because of this higher increase in cost of sales. And moving beyond that, you still see the same issues with FX and it's affecting their finance costs, affecting their bottom line. And given the fact that we had the massive devaluation back in the first quarter of the year, and so their first half results still incorporates that first quarter results, and it's what we're also seeing significant finance costs for a number of them.
Right. I mean, these companies are going to have to get really creative and innovative in terms of how they balance these rising, especially cost of sales, passing on price increases to the consumer, and also staying profitable at the same time. But how do you see this playing out? I'm looking at the numbers. For instance, Boa Foods cost of sales up 141% at 453.9 billion. That's in the half year this year. For a company like this, for instance, what would be, next steps in terms of how they begin to get creative with bringing this particular line item down?
So the first thing that what they might do is backward integration. That just simply means trying to look at local content to reduce their importation, because importation is one thing that's, as long as they keep it elevated, you would keep on telling on their books. And because they have their payables and as well as the FX rates and how all of that interacts. So what we're seeing is that they're looking at local content to replace certain parts of their production process. And those who are able to do this faster than the others are going to see their cost of sales moderate at a faster rate than the other. So that's one thing they're doing. While for the revenue line item, they're trying out different strategies, looking at how to mix their price with their sizing, their offerings, and focusing on particular products that can drive bigger margins than the others. So they're basically trying different strategies across board just to keep their revenues growing without losing a lot of volumes, and while looking for how to also tame the growth in their cost of sales.
Now, I'm looking at Dangote Sugar, gross profit down 68.8% year on year. Now, I know that, we do have a sugar master plan. I know that in the past, in the not too distant past, the government has tried to assist, with the sector. Talk to us about what the challenges remain outside of maybe, internal, how the company, in terms of how much they're selling, in terms of volumes, price increases, etc. But talk to us about the challenges within the sugar value chain.
Okay, so what we have currently is that a lot of the sugar that we consume here, we have the raw sugar being imported and then that being refined. So the biggest players that we have are refineries. That's Dangote Sugar Refinery, the Bua Refinery, as well as the one by Flour Mill. So they're refineries basically. They import most of the raw sugar and then they have to refine it. So the idea of the master plan is for backward integration to now reduce that raw sugar importation by planting massive sugar plantations within the country so that they don't have to import raw sugar again. Yeah, however, that has its own challenges as well in everything from manpower to capital to security. It's a really massive project that will require a lot to come to fruition. For Dangote Sugar, for instance, they've invested a whole lot and in their various plantations, especially the one in Adamawa and the one in Nasarawa. But these are medium to long term plans, and it doesn't help that they also have to deal with other issues like I mentioned, security, for instance, as well as escalating cost, in also bringing these plantations up to full capacity. That's also a challenge as well. So we're likely to see the targets or the forecast for the completion of backward integration plans to be shifted because they are also having to deal with operational issues in bringing all of their plantations on stream. Now that's across the various refineries. So in the short term or in the near term, we're seeing them still importing a lot of their raw sugar, and of course that's also mean that they have to deal with the higher FX rates in importing this sugar.
Now, for the shareholders of these stocks, especially for Dangote Sugar, obviously they're looking at these numbers. They're not too happy. They're wondering about the immediate in the immediate term, what's going to happen in terms of the growth prospects of these companies, and very importantly, how they're going to navigate these headwinds that continue to weigh heavily on their bottom line. How is this impacting? Are you seeing any trends in terms of how these numbers have impacted the stock prices of these companies so far? And what is your forecast going forward? I know that you're crunching the numbers and you can forecast, perhaps give some kind of guidance in terms of what these numbers would potentially look like in the quarters to come. But how are the shareholders themselves interpreting these numbers and how they're going to be trading these stocks going forward?
Yeah, so shareholders are really looking at the earnings per share. They're looking at what is left after everybody else has been paid in the quarter or in the half year or in the full year that can potentially be distributed to them. And right now, for a number of these companies, they are unable to pay out dividends because their cash is being tied up to either pay off loans or pay off payables. That's people who supply them their inputs. So that's a challenge for investors. But we've also seen that some of these names are very notable in the market. So a good number of their investors are long term. A good number of their investors are also parent companies, and that means that they don't necessarily reduce stakes little by little. They're in for the long term. So when this happens, what everybody's then thinking is, okay, how can we contribute to ensure that it's a turnaround as quickly as possible? But we've also seen impact on their stock prices. We've seen the consumer goods sector get beaten down in a number of weeks. And for a number of these stocks, we currently have a buy recommendation on them because we think they'll be beaten down below their fair value. And we also consider the fact that the companies are also restrategizing in their capital raises, both debt and equity. And we think that would ensure that they can still grow for the long term.
All right, Oluebube, we'll leave it there. Thank you so much for sharing that with us. We appreciate your insight on that. Oluebube Nwosu, Consumer Goods Analyst at Vetiva Capital.